AI is incredible. It can teach you how to fry an egg and even write a poem, pirate style. Yarr! But it knows nothing about your work. Slackbot is different. It doesn't just know the facts. It knows your schedule. It can turn a brainstorm into a brief. And it doesn't need to be taught. Because Slackbot isn't just another AI. It's AI that knows your work as well as you do. Visit slack.com/meet Slackbot to learn more.
Pepsi Prebiotic Cola in original and cherry vanilla. That Pepsi taste you love with no artificial sweeteners and 3 grams of prebiotic fiber. Pepsi Prebiotic Cola. Unbelievably Pepsi.
I just can't get these numbers to add up.
Like we're never gonna get out of this hole.
Credit card debt, does it ever end?
Maybe I can help. We sure could use it.
We've tried debt consolidation companies.
We've even taken out loans to help make payments.
Did you know millions of Americans live with debt they cannot control? That's why I developed this unique new program for managing your debt. It's called Don't Buy Stuff You Cannot Afford.
Live from the basement of the YouTube headquarters, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and as we approach graduation season, it's time to look at your own money report card. What should you know to graduate in your financial life? Today, we're helping you create a better curriculum to learn about personal finance with a fantastic team of contributors and a live YouTube audience. And that audience will be helping us along, except when it comes to our year-long trivia contest at the halfway point of the show. And now, a guy who's helped lots of people graduate with better money habits, it's Joe Saul-Sehy.
Hey there, Stackers, and happy Friday to you. Welcome back to the Stacking Benjamin Show. I am Joe Saul-Sehy, and I'm super happy that you're here, whether you're here with us live on YouTube or you're listening at home on Friday. We got a great show for you today because this idea of a financial curriculum, we know there's a bunch of stuff that we need to know. And I also know that when we do these podcasts 3 times a week, we skip around a lot. So how do we build that foundation from the bottom? Well, today we've got a team that's going to help you with that, including the guy who just so eloquently did the introduction. Mom's neighbor Doug is here. How are you, man?
I'm great. I love when you say that I did it eloquently. It's like I'm Charlton Heston reading from the phone. Like I can make anything to sound like with the cool British accent. It's great for my ego. So thanks, Joe.
Well, I'm not saying that you're Don McDonald from Talking Real Money. You're not that level, but you're the next step.
Thanks for keeping my feet on the ground.
Doug, we do got a great show today. I mean, you outlined it pretty well. This idea of a financial curriculum, that's something you can get behind.
Oh, yeah. We all need a playbook. We all need a recipe once in a while, and we're here to dish it out.
And a guy who's got the recipe every Friday and Monday and Wednesday, Mr. OG's here with us. How are you, man?
I'm great. How are you?
I am
happy to be here, Joe. First time caller, long time listener.
It is fantastic that you're here and you're ready to help people get the curriculum in order. I mean, you see people, they're at totally different states of readiness. Like people come to you in your financial planning practice, and some people are, 400 levels. Some people just like, which way is a savings account?
Yeah, that's right. Let's talk about it today.
Can't wait to do that. And the woman who's going to help us do that today, as she does most Fridays from Afford Anything, Paula Pant is here. How are you?
I am riding high from last week's victory.
She's still enough.
I knew I turned it off too early. I was on vacation and I was watching some of it and I was like, I'm good. Whoever's filling in for me has probably got this easily handled.
Well, and had it been this year, Paul Merriman, who sat in for you, he would have had it been this year, OG.
Oh, I didn't see the question. So just another controversy, basically to add to the stack of controversies the first 12 weeks. I like it.
Yes. And we're going to resolve, for those of you longtime listeners that know there's a controversy, we just got the answer back from Wichita, Doug, and we're going to resolve that at the halfway point.
We are. Thanks to Dottie and all her hard work sitting in her studio apartment in Wichita, smoke-filled studio apartment. She finally came up with a resolution, and we will have it for you during trivia.
She looked at the tape to see if Jesse's foot was on the line, and she has her ruling. So we'll have that partway through.
Dottie reminds me of Roz from Monsters, Inc.
That guy.
I think that's pretty accurate.
And our special guest today, the guy that's going to help us get this curriculum in order, he is the mind behind the Fortunes and Frictions blog. It is the one and only financial advisor, Ruben Miller, is here. How are you, man?
I'm fantastic. Thanks for having me.
For people that are brand new to the world of Ruben Miller, tell everybody about what you do, man.
Well, I write the Fortunes and Frictions blog. I run the second most important RA in Texas, as Josh will tell you. I have a little boutique RA here in Austin, Texas, with a few other people. We all used to work at Dimensional Fund Advisors, so we kind of came from the investment world, and now we do the financial planning world. Most people do the opposite. They learn financial planning and then learn investment. So it's been a fun little journey. We're about 3 years old. And then I hang out on the internet, mostly on LinkedIn, and Josh just basically makes fun of me on there, and I deal with it.
That's shocking. OG making fun of anybody? That's
I don't.
So weird.
I actually think if you don't follow Ruben on LinkedIn, he's a great follow, mostly because he says the things that everyone wants to say, but don't have the, what's the word I'm looking for? Cojones to say out loud. So
I came from the fund world where there's a lot of compliance. And when I left, it was pretty liberating. I like calling out Wall Street for what it is. And we run our firm that way. We run our lives that way. So yeah, I'm not afraid to sort of call it out there on LinkedIn.
One of my favorite things that you called out in your blog post at the beginning of this year, people go to your website, which we'll link to on our show notes, is your predictions for the financial market, your expectations, Ruben, because you guys had phenomenal expectations. I mean, JP Morgan puts theirs out there. Chase has theirs.
Yeah, Goldman's got theirs.
Goldman's got theirs.
Ruben's.
Can we run through yours?
Sure.
What is Ruben Miller's expectation for large caps in 2026?
Yeah, we don't have one.
Okay, hold on, because you must have one then for small caps. It's got to be small caps that you have. What's your expectation for small caps?
We also did not publish one.
Okay, wait a minute. What about international?
None.
Oh, come on. Bitcoin. How about crypto? You must have crypto.
Yeah. Unwilling. Unwilling. No, not against owning it, but unwilling to make a forecast on where it'll go in 1 year.
Yeah. But what I love is your point there. What's the bigger point you're making?
I think it's an expectations versus reality thing for investors. And we're all in the ecosystem of Wall Street. That's who has all the advertisements, and that's who owns the stadiums and puts the commercials on. And so we all just are accustomed to it being normal for some brokerage or wirehouse to come out and say our S&P forecast for the year is 7.5%, and our expectations for inflation or crypto or whatever it might be. And the reality is, if you look at the long-term data, no one should be making those forecasts on a 1-year basis. And so a few years ago, I started putting out this blog post at the beginning of every year where I said, look, on risky assets, we don't have a forecast, and our clients better be cool with that because that's the only way we're going to do it. I do think it's important for investors to realize that all assets are on a spectrum of our ability to forecast what we expect them to do. And so some more reliable investments, maybe like traditional bonds or short-term bonds, something like that, it is reasonable to have a forecast of a range of what that might be. But when it comes to something like small caps or international stocks, it's a fruitless effort. And you see it right now with the recent downturn of what's going on in the Middle East. You have these banks and wirehouses now updating their forecasts. What the hell use is an update of a forecast? I gave you my money January 1st to do the right thing with it. I don't care what you think now. How did we do the last few months? And I think you can have a better investment journey if you don't play that game.
Paula, your economic updates would be horrible if it was all Ruben stuff. You'd be like, yeah, we got nothing.
My economic updates are always backwards looking. So those updates are, here's what happened in the economy in the past month, not in the future month.
Well, thank goodness they're not forward looking, and Ruben's not your only contributor, because that would be an awfully
fight.
Well, we've got a fantastic show today because people come at financial planning as Ruben, OG, and Paula, you guys all know. They come from different stages of life, and they're all starting in different spots. And we tend to skip around a lot in the world of podcasting. So really putting that foundation together, where does it come from? We've got a Wall Street Journal piece that I was very fascinated by. And I thought, you know what, even if you're not in high school, which is what this piece is about that I'll get to in a moment, what if you decide, you know what, I want to go, quote, back to school with my money? Where do you begin? We'll get thoughts from Paula, from Ruben, from OG, and maybe from people hanging out with us on YouTube. First, we have a couple of sponsors who help us keep on keeping on. So we're going to hear from them. And then let's help you start your personal finance curriculum. Spring cleaning's made its way to my closet. This time of year always makes me rethink exactly what's in my closet. Really want to keep fewer things, but I also want to keep better ones. I want to feel confident And to feel confident, looking the part's a big piece of that. So I want pieces that are well made and that are easy to wear all the time. And that's why I keep coming back to Quince. The fabrics feel elevated. The fits are thoughtful. Pricing actually makes sense. As I'm swapping out and I'm cutting, the few additions I'm making all come from Quince. Quince makes high-quality, everyday essentials using premium materials like 100% European linen. They're insanely soft, flow-knit activewear fabric. Their men's linen pants and shirts are lightweight, they're breathable, they're comfortable. Basically, the perfect layer for spring. The pants strike the right balance between laid back and refined. If you saw the video of me on stage at Retire Meet, those pants are from Quince. It was really cool. I came off stage and Christine Benz from Morningstar getting ready to go on behind me and said, "Love your pants." Not generally. I absolutely love them. I think they make me look put together without trying too hard. And they're flow-knit activewear, moisture wicking, anti-odor, soft enough that you'll actually want to wear it all day. The best part is their prices. This is important, stackers. They are 50 to 60% less than similar brands. How? Quince works directly with ethical factories, cuts out the middlemen, so you're paying for quality, not brand markup. Everything's designed to last and make getting dressed easy, which is another thing I think we all want. I love those pants that I wore on stage. It's the cashmere sweater that every time I wear it, Cheryl goes, "That is my favorite sweater on you." It looks great, feels great, and I don't have to have 50 things in my closet. So, like I am, refresh your wardrobe with Quince. Go to quince.com/SB for free shipping and 365-day returns. Now available in Canada, too. Go to QUINCE.com/SB for free shipping and 365-day returns. Quince.com/SB. You may not know that when we started Stacking Benjamins, it was a blog. And even then, just the startup cost, I remember thinking, is this the right thing? And what if I write things and nobody comes, right? Well, luckily, that didn't end up happening. But starting something new isn't just hard. It's terrifying. There's so much work. You're not sure whether it's going to work out. You're not sure if anybody's going to read it. And then we change it to a podcast. Is anybody actually going to listen, right? What if nobody wants all the stuff that we have? Well, had I used Shopify, it would have been even easier, because with their expertise, their helpful tools, and their easy to use platform, that's something that would have made Stacking Benjamins more effective much, much more quickly. Shopify is the commerce platform behind millions of businesses around the world and 10% of all e-commerce in the U.S. Names you've heard of like Heinz and Mattel, Shopify, Gymshark, Aviator Nation, Allbirds, also all Shopify. Get started with your own design studio with hundreds of ready-to-use templates. Shopify helps you build a beautiful online store that matches your brand style. And best yet, Shopify is your commerce expert with world-class expertise in everything from managing inventory to international shipping to processing returns and beyond. And did I mention that iconic purple Shop Pay button? It's used by millions of businesses around the world. It's why Shopify has the best converting checkout on the planet. It also helps boost conversions, meaning less carts going abandoned and more sales for you. So you're stacking Benjamins much more quickly. Time to turn those what ifs into with Shopify today. Sign up for your $1 per month trial today at shopify.com/SB. Go to shopify.com/SB. That's shopify.com/SB.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamins headlines.
Today, our headline comes to us from the Wall Street Journal. This was a great, inspiring piece written by Oyen Adedoyin. The piece is called "What's Cool in High School? Personal Finance." It seems that states are ditching economics and instead giving us more practical education. We are up to, this is some great news, guys. We are up to 39 states that require a personal finance course to graduate high school, with 4 that have added it since 2024. That compares, by the way, with 22 states that ask students to take economics. That's down 4 since 2024, according to a report from the Council for Economic Education. This idea of a curriculum, Paula, they're getting it in school, but it's pretty cool that more states are adding this. Like, I feel like states are going, oh, wait a minute. Instead of teaching you about,
the
I don't know, Thomas
Pythagorean theorem,
Paine.
because of all of the times I've
Right.
used the Pythagorean theorem throughout my life.
Right. Now we're just in time to teach people how to balance a checkbook when kids are like, what's a checkbook?
Yeah. I had a roommate once. I mentioned writing a check and she was like, you know what? I don't have any checks. And even if I did, I wouldn't know how to write one. And I said, oh, I'll teach you how to write one. And she said, oh, well, then can I just borrow one of yours?
Seriously, though, she was being serious.
Yeah,
Yes.
which if you don't know how to write a check is actually a reasonable question.
Yeah, 100%. I'm all out. Why don't I just take one of yours? That's awesome.
I love the fact that schools are teaching personal finance. I think this is a wonderful development. I do not like, however, the fact that in the article it's pitted as an instead of economics. I think it would be better as a both and rather
As a
than an
1-2
either
punch.
or. Yeah.
But I do feel like if I am somebody out of high school listening to us or watching us, and I see that more schools are figuring this out, most states require it now, shouldn't that mean we all should be building our own financial curriculum?
Like as individuals?
Absolutely.
Yeah. Well, and I mean, lifelong learning generally is something that I believe that we all should pursue. But there's a difference between policy that you make for the aggregate versus the decisions that you make as an individual. And when it comes to policy for the aggregate, particularly when it comes to curriculum in schools, personal finance is a wonderful development, a much needed development.
Ruben, your whole Fortunes and Fiction blog is basically about how money doesn't behave the way the textbook says it should. Are we even teaching the right stuff?
It's a great question. I don't know what each of these states are teaching. When we think about personal finance, there's so many parts of this. There's core parts of personal finance that I think are the foundation to understanding how money flows through our lives. So if I take a personal finance class in high school, I'd like someone to teach me what the time value of money means. I can't see a world where that's not useful. But if you teach a 17-year-old about how mortgages work, is that going to be relevant to everyone, especially when they don't use it for 10, 15 plus years? I don't know. Teaching personal finance in schools gets thrown out there as like a ubiquitous good, which it probably is, all things considered. But it's a lot more nuanced in implementation. We now have, as you said, 39 states or whatever it is. Like, what are you actually teaching? What is the curriculum? And are the kids going to remember it? So much of our financial lives, the way we get paid, 401k matching, these things are not relevant to a 7-year-old and they don't care. I think it matters a lot, sort of what foundation are you laying and how do we do that in a way that a lot of it sticks in their brain for a long time.
It's interesting that you say that because I remember when I would give talks at high schools, Ruben, I would always take questions at a time. And every single question was a different facet of how do I get myself into debt up to my eyeballs? Like every single question.
Yeah.
Don't get me wrong. It wasn't phrased that way. It was when I graduate, how do I finance a truck? How do I get a credit card? How do I get student loans? Everything was debt focused. A friend of mine, Gene Natali in Pittsburgh, said that when you talk to kids about debt or about mortgages, like you talked about, we lose them. But when we actually talk to them about getting wealthy, something they think they can do, beginning with the part-time job they have, all of a sudden the Roth IRA, you teach them the Roth IRA, he's like, you see their eyes light up because that compounding interest thing, Ruben, you talk about, that's dynamite to a 16-year-old. Wait a minute, time's on my side and I'm 16. Holy crap.
I think that similar to our lives as older adults, it's all trade-offs. The whole world of personal finance is just trade-offs. It's just that for them, it's a little less tangible. I remember being 16 years old and I wanted my mom's credit card so I could go buy crap. I didn't understand it, right? No one had laid down to me what happens if you contribute the max to a Roth every year. So I do think it's about reinforcing that. They do care when they see those numbers pile up. That is what they want. But this idea of immediate payoffs and getting those dopamine hits, they're harder for 15, 16, 17-year-olds to avoid that. Like they're more susceptible to it than we are as older adults. And so again, I think it goes back to like, it's complex designing a personal finance curriculum, but there are going to be some core tenets that are going to be relevant your whole life.
Well, and that's a great segue. Let's go around. If we're beginning our journey then, where did somebody hand you a blank syllabus, Life and Money 101 for the average person? What's lesson 1 in your book?
Oh man, you had to pick me first. I was all ready to talk about the fact that my 16-year-old yesterday said, "Can you teach me how to day trade?" And I was like, I would love to learn from you if you know what to do, actually. And he was referencing a friend of his that he said, well, such and such a person started with X dollars and now has this, has been really successful with this. I'm like, that's awesome. I don't know that those things are connected. I was thinking about this in the context, Joe, of, and maybe just dovetailing a little bit off of what Ruben said about like not having any control over the content. I think it's probably a good thing that there's somebody somewhere that's saying, hey, we need to have some sort of education on personal finance, like whatever the hell that means to whoever decided to do it. Right. But is it one of those things where we're trusting that the government officials we talk a little bit about broke professors a little bit on the show, you and I do, Joe, is it like, do we have the problem with we might be teaching the wrong thing or focusing on the wrong stuff? And if I were looking at this, or how I think about this is as a parent, and I've got a 16-year-old and a 19-year-old and even a 9-year-old, I feel like this is our job, in terms of our responsibility to share the story of money, and I think, Ruben, what you were talking about like, nobody cares about like how mortgages work. My 19-year-old could give a crap about that. But what he does care about is, I still don't think he understands the impact of not paying off credit cards. We were talking about it and he's like, well, I don't understand this interest. Like, why would you, he had actually had a really great idea. Or a great comment. He was like, why would you charge something that you didn't want to pay off? Like, why would you want to pay more?
Save that moment, Josh.
For the thing. I know.
Cherish it.
I know. But because they didn't teach this in school, and he's got a credit card for when he went to college. And he's like, what do I do with this thing? Because his whole life has been, I just Apple Pay with dad's money. And now I'm like, well, hold on. You're 18, bro. Like, this is on you now. Like, I'll pay for college, but if you want a sweater, that's on you. So he's trying to like learn that stuff. And like you said before, Ruben, it's like the really relevant things are, how do we teach kids, or anybody for that matter? I mean, I'm 48 and I still need help doing it. Like, defer gratification, just a smidge, like,
is that
just
it,
a little
though?
bit.
Yeah. Let's get away from school and what we learned there. Let's just design our own. Like, do we begin no matter what age we are? You know what? There's people watching this that are 50 that are like, I think I'm too late. There are people that are 35. Like, we don't know where they're starting from. Does it start, OG, with cash flow? Does it start with emergency fund? Does it start with don't screw up the basics? What is lesson 1 on the lesson plan?
I think if you're designing your financial curriculum, I think the first thing is taking stock of where everything is and not kidding yourself. If you're going to look at your cash flow, you got to count everything, right? If you're going to look at your net worth, you got to count all the assets and all the debt. I think the first order of business, if you're starting over, whatever that looks like, is to go, where is everything at presently? And that is being truthful to yourself. You're the only person there, so you don't have to prove this to anybody, but don't lie to yourself, because, you're the most trustworthy person that you know of. So be careful with that. But I think if you're going to start, you got to start with, what are the facts of the case? Where is everything? How much money do I make? How much, where do I spend my money? How much money do I have? Who do I owe money to? Start there.
Do you like that for a starting place, Paula?
I like it. But one thing I would add to it is, what is coming up in my life in the next 3 to 5 years? And when we're talking about high school students, the answer to that is the decision around whether or not to go to college. And if you're not going to go to a 4-year college or university, then what? Are you going to go to a 2-year school? Are you going to go to a trade school? Are you going to start working right away after high school? If broadly speaking, any person at any age can ask themselves what's coming up in the next 3 to 5 years. And no matter how old you are, that answer might be, I need to replace my car because my car is 10 years old. And in the next 3 to 5 years, it might break. Or in the next 3 to 5 years, I might want to buy a house. Like, when you're older, those might be your answers. In high school, yeah, it's in the next 3 to 5 years, I need to figure out what the next step is in terms of either vocation or education. And then how am I going to pay for that? And so my hope is that these high school personal finance classes have a lot of how much debt should I take out, if any, built in.
But I'm going to say this, guys, for the 5th time. You're all stuck on high school. Mm-hmm. I don't care about high school. Yeah. Let's say that you're 50. Let's say that you're 35. Let's say that you're whatever age.
Yeah.
Yeah. Where do you start there? And Paula, I'll take that and widen it out for the 35-year-old. What I hear you saying is this weird phrase that I just came up with. You can afford anything, just not everything.
Right.
Like, this idea of trade-offs feels like it's where you would start.
Exactly. Well, and that's what I mean by the next 3 to 5 years. So maybe you want to replace your car because you've got an old car and you know it's a clunker and you know it's probably going to die. Maybe you want to buy a house. Maybe you want to take a sabbatical from work and travel for 6 months. Or you plan on switching jobs, and in that interim period, in between jobs, you'd like to take 6 months. And all of that is going to require financial planning. And those are all things, when you're talking about retirement or you're talking about a goal that's like 15, 20 years into the future, it can be harder to visualize what that's going to cost. But when you're talking about that 3 to 5 years in the future, even if you're 50 years old, it's easier to put numbers on it. And then it's easier to work backwards to say, what's this going to cost and what do I need to do today in order to be able to set that money aside?
What I like, Ruben, about what Paula's talking about is this idea of beginning with what's really important to you right now, because I feel like financial planning gets really good and it's easier to pick investments. It's easier to understand insurances. It's easier to, if it's all aligned with this thing that we want for ourselves, because now we've got a little, I don't know if it's greed or fear involved, maybe both, but is that where you start? Do you start with goal planning and then the curriculum kind of flows out of the goal?
Yeah, I'd be interested in what Paul and Josh would say to this, but basically for us at our firm, we think about the organization process of getting all these assets and liabilities together. Once you have that loaded up in a spreadsheet or a financial planning software or something, that's there. And you can either sync it and it automatically updates through time, or when you readdress your financial plan, that updates through time. That part's not, to me, doesn't take a lot of time afterward. It's kind of what Paul was talking about. Just like when you hit these inflection points of what am I trying to accomplish in the next 3 to 5 years, and these big moving rocks that we're trying to either endow through our assets or debts we're trying to pay off or whatever it might be. I think that once it's all set up, most conversations I find that we have with our clients are really about unpacking what is the distribution of likely outcomes here. If we do all these things and we have our portfolio, let's say we have a 70% stock and 30% bond portfolio or something, like what's likely to happen? How's this money likely to grow? And in this distribution of things that will happen in our future, how do we mitigate some of these tail risks of really bad outcomes, making sure they don't shock our lives? Because to your point, Joe, then that's where it's like really about, if I can't do what I want in life, then my financial plan failed. It doesn't matter if I beat the S&P or not. To Josh's point about day trading, this is not just a problem with teenagers. This is a problem where everybody's enticed by hearing about their friend who made a bunch of money trading zero-dated options. The challenge is it's always going to be a distribution. There's always going to be a few people in the right tail who crushed it. Even if 95% of the people go bankrupt, we're always going to hear about these 5 people, and people are going to be enamored by that, especially if they don't understand distributions. So to me, it's more of a quanti-statistical answer, but like I really wish people understood distributions of likely outcomes more.
I got a C+ in statistics, Ruben.
I wasn't far behind, to be honest.
So I get the concept, but I think, sometimes you look at those, and I'll use financial planning as charts or Excel, or there's a lot of million tools that people can use to build their own plans. And so you do that and you see this number, right? And it says, okay, if I put this money in my account, it says, $17 million when I'm 100 years old, or 65, or like whatever. And we look at that and we go, this isn't right. Even if it's just an Excel formula that you dragged over for 30 years, it's some number that is an unbelievable number. But the real number is somewhere in a range of returns there. And I think maybe what you're talking about here is understanding what that range looks like and planning around the variability of that, maybe, as opposed to saying this is a linear outcome. I'm either going to succeed or fail. It's like, well, no, succeeding and failing is not binary. It's not $0 or $1. You'll have some money. You might have a lot, or you might have not as much as you think, but you're going to have some. And how do we address that as the years go on, as you get closer to these liquidity events or things that you need?
I like, Josh, about your story about...
Hold on. We got to stop that for a second. I think that's the first time Joe has called me Josh in like 15 years.
Yeah, Ruben did it, and all hell broke loose.
No, you can, Ruben. It's fine, but...
Ruben is contagious. My bad.
I wasn't listening the first part because I was like, who's this? Who's this Josh guy?
There's an interesting piece about your C+ story, because I feel like a lot of the time these concepts don't make sense to us because they're not connected to our real life. So this idea about distributions or risk or whatever, we don't grab onto them because they don't have any real meaning. I get the feeling, OG, that it would have meant more and maybe you would have done better if it was attached to your goal, because as an example, Monte Carlo simulation. Like you look at the variability in a Monte Carlo simulation and how the statistics work out for that. If you just said Monte Carlo simulation, blah, 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 here's the statistics, I go, whatever. But if you said to me, this is your probability of being successful in your retirement with 0 moves, I'm all ears. Like, I'm like, wait a minute, how does this work? What are the downsides? What's the process they made this? Like, I'm fascinated. I feel like some of these abstract things, if we start to make this curriculum, we get pretty good at in a hurry.
The whole piece about, like you said, curriculum is taking the parts of money, which are from simplistic things like creating a net worth statement to the invest like the 1%. And, you see these esoteric type of tools that people can use, or strategies, I think is a better way of thinking about it. And trying to gain enough understanding to recognize the areas that you should focus in on. I'll just use a very simple example. I think generally speaking, most people would say annuities suck, unless you sell annuities. Then you think they're pretty awesome.
Or you're married to someone who sells annuities.
Fair enough. Yes. Yes. If the likelihood of you paying your Amex bill is determined by how many annuities are sold in or around your person,
blanket,
you have a particular feeling about it. But I think we could all intellectually step back and say, there are cases that this makes sense. There are some scenarios and there are some tools. It's an arrow in the quiver. It doesn't make it a good arrow or a bad arrow. It's just an arrow. And sometimes it's useful and sometimes it's not. And maybe that's a broad statement for that particular product. But if you say something else like a charitable remainder trust, it sounds pretty cool. Like some charities maybe that will remain in a trust, maybe, it's a good place for them. There's so many different things. And I feel like the problem with personal finance or financial planning in general is there are so many ways to get yourself in trouble. And part of your curriculum, part of your learning has to be around, is this even relevant for me to even be thinking about right now? Like, I think all of us generally know what a charitable remainder trust is. Maybe half the people listening have an idea of what that is. But for the half the people that don't, they might be going, well, maybe I should know. Maybe I should spend energy on this. Maybe should I call my attorney and find out if I need, like, this is all just probably energy that you can put on other things that will produce a better outcome. So part of education is, not going a mile deep on every single thing, but just a little bit to know, like, this is relevant for me or this isn't.
Well, and I think you're more likely to do that if you begin with a plan, right? If you begin with your own plan, then you're like, I'm interested in charitable giving. What are the outcomes that I'm looking for? And then, Ruben, were you going to say something?
Yeah, I was going to say that once you have all your information organized, or if you work with a financial planner and you go through a financial plan, I think what Josh is really highlighting is this idea that, like, the magnitude of our decision-making and the outcomes of our decisions, that magnitude changes through time. Like, a 23-year-old probably doesn't give a shit about giving money away to charity right now. It doesn't move the needle. It might really move the needle for a 60-year-old who just sold their business that year. We have this client. This is just a funny thing that happened to us this year, who a very, very large client. It's the first time he's had an HSA. And we had all this frustrating paperwork to, like, open this HSA that was at one place and have the account we can invest at Schwab. And the magnitude of this HSA in this guy's life is de minimis. But we had
it's like an $8,000 decision and it takes you 7 weeks to get open.
It's de minimis. And yet we have this frustrating paperwork process that Schwab wasn't approving it and whatever. So, like, for him, it doesn't matter. For a 23-year-old, HSA is an incredible tool. Maxing your 401k and getting a free employer match is an incredible tool. So the magnitude of these things we can do in our financial life changes through our life cycle. And I think it's important to have an idea of that. Otherwise, you just jump on podcasts, you hear people talk about charitable remainder trust, and you're like, that's cool. How do I do that? Like, actually, maybe that's not that relevant to you.
Right. Yeah, we start learning a ton about the wrong stuff. I'm going to propose a structure that in the second half, I'd like us to just play with. That if we start off with, in our curriculum, a foundation, I'm going to ask you all a couple of questions. Number one, what do you think people learn too late that should be a part of your curriculum? Number two is maybe what's a good resource that's not the 5 of us for people to get more information about that. I think if we start off with foundation, then we'll talk about risk management, growth, which will include investing, retirement, taxes, big decisions, I think I'll call the 4th area, and then more advanced stuff like negotiation, behavior, financial independence, like some of these these more heady philosophical things. Well, not necessarily when it comes to negotiation, but behavior and financial independence mostly. But I'd love to get your take on the two of those things. What do people often miss in the curriculum? And then number two, what's a good resource for us? But before we get to that, we have something very important we have to do, because on Fridays, if you're new to the show, we have a year-long competition between our three frequent contributors, OG, Paula, and Jesse Kramer. And by the way, Ruben, you're going to be playing on behalf of Jesse Kramer. You know Jesse.
Yeah.
And I got some good news from Jesse, by the way. As we record this, last week, I found out it was Jesse's birthday. And so I texted him and I said, dude, is it your birthday? He said, it is. And he showed me a picture. And
cool.
Many of our Stacker family might not know this, but Jesse and his spouse, Kelly, were expecting. And on Jesse Kramer's birthday, Kelly gave birth at 2:47 a.m. to Tess Elizabeth Kramer, sharing a birthday with her dad. So 8 pounds, 4 ounces. And Jesse said, and she's hungry, and Kelly is doing well and resting. So congratulations to the Kramers with their new member of the family.
Just a real quick point. Do you have 190 unread messages? Is that what that said on your phone?
Does it say, it says 282.
Oh my God.
Yes.
Folks, if you're trying to get a hold of Joe, this is...
I think I'm a distant second to Paula Pant, though. I think.
Oh,
I bet
Paula,
Paula
do you have
says,
a bunch of stuff unread?
Oh,
I bet Paula
yeah.
says 1,500.
Really?
Yeah, it's pretty up there.
How do you live with yourself?
My phone's plugged in over there, so I can't check
Why
it
even
right
have
now.
a phone? What's the point?
Right?
Just start over. Just redo it.
I have to admit, Paula and I have laughed about this before. People are like, hey, I know you're friends with Paula. Could you get a message to her for me? Could you wave your arms?
I just don't understand how people are able to tolerate so much inbound. It's just,
It's good.
It's bananas.
It is good that you can focus, Paula. That it is an amazing trait. But 2 weeks ago, we had a controversy. 3 weeks ago now, actually, we had a controversy, which was we had mentioned...
slight disagreement.
We had mentioned that Jesse could margin call OG when he didn't have any points. And as we reviewed the tape, we found out that, yes, in week number 1, we had said that you couldn't margin call somebody without a point. So in fairness, while Jesse keeps his point, OG goes back up the point that he lost because Jesse couldn't margin call him. However, we do have a better rules explanation than we had at the start of the year because we didn't realize just how crazy this was going to become. So Doug, for Ruben, because it's his first time on the show doing this, and for everybody else listening to this amazing trivia competition, Doug, what are the rules of our Friday trivia?
Yeah, I will recite them now, Joe. I think this is a big lesson for us. We had no idea just how invested our stackers are in trivia. Boy, did we find out.
There was anger, Ruben. There was anger.
Oh, it was vitriol on the highest level. So here they are. Here it is, everybody. And pay attention because the most important rule is last, but we're going to build up to it. So rule number 1, each contestant gets 1 margin call per quarter. If a contestant has 0 points, they can't use a margin call. They specify the opponent that they're margin calling. They can utter that phrase margin call at any point. The second I start reading the trivia question, they can say margin call on OG or whoever. It's probably going to be OG. Let's be honest. Rule number 2, if the person margin called, OG, gets the correct answer, they gain a point as usual, and the margin callee loses a point. So you stuck your neck out there. You tried to make them pay, but it didn't pay off because the person you called got the answer right. You're going to lose a point. If the person margin called gets the answer wrong, they lose a point. And rule number 4, if the margin called, the person who got margin called gets the wrong answer and the margin callee gets the correct answer, it's essentially like a 2-point swing. Because when OG got margin called and he got it wrong, he lost a point, and the person doing the margin calling got the answer correct, they win a point. That's a major swing in the field of battle. But here's the most important rule. Rule number 5, trivia host.
This is the rule we should have mentioned at the beginning of the year.
Yes. Trivia.
That we are now 100% putting into effect.
Right. Trivia host, this guy, reserves the right to make up any and all rules necessary if one contestant starts running away with the competition and or gets a big fat head about being in the lead.
You guys are jackasses.
Wait, so rule number 5 is that there are no rules?
I mean,
Ruben, just so you know, it was 7-0-0. And then all of a sudden,
somebody kept bragging about it, Ruben. Somebody kept bragging about
bragging.
it.
I was just winning. You know, it's like the DJ Khaled song, man. What are you going to do? Like, that's all we do is win here. But apparently haters going to hate, as they say. Hate.
Well, it sounds like a very host-friendly approach, and I'm here for it.
It's all about the listeners, Ruben. We're trying to make this exciting and compelling for our stackers. We don't want to get to October, OG's winning like 39-0-1, and there's no point in doing trivia anymore. So we got to keep this a battle, and we'll do whatever we have to.
But let's be realistic. Doug, that is number 2. Number 1 is watching OG's head explode when we change the rule.
Fair point.
Like that is
fair point.
That is purely what we're doing is entertaining ourselves at OG's expense.
Joe, did you understand from Dottie in Wichita that as a revision after the rule review, that OG, who previously had 7 points, he's back to 6 points now?
He regains the point that he had called.
So he's back up to 7. Okay, so it's now our score now, after Paula's miraculous performance last week, our score as it stands right now, OG in the lead with 7. Jesse / this week, Ruben, you're the beneficiary of his illegally gotten gains previously. He has 1 point. And Paula now has 1 point. So it's 7-1 going into today's competition.
Deal. And Ruben, guess, just to keep it easy, don't margin call. So don't worry about all the margin call stuff. You just get to answer the question, which is fantastic.
We ready?
And this is the first episode of Q2.
Everybody has a margin call again starting right now. And to do that, we actually need now that we got through that, are we ready for some trivia? Let's go.
The trivia question is, how many rules are there?
Yeah, what are the rules?
Here's what's going to happen. OG, because he's in first place, is going to guess first. Ruben, because Jesse was last year's champion, you're going to go second. And then Paula gets to go last. And it's closest person to the answer, either side. It doesn't have to be close without going over. It's just closest. Doug, you've got the question. What are we talking about this week, man?
Hey there, stackers. I'm Joe's mom's neighbor, Doug, and today we celebrate the birthday of iconic comedian, actor, and big fan of the show, Eddie Murphy. Yeah, Eddie and I were together a lot growing up, and old Eddie was crazy. He'd crack some joke, and, of course, I'm going to laugh. I mean, it's Eddie Murphy, right? We're pretty much best friends, except he was always up there on the movie screen, and I was just in the audience watching him. But other than that, we were tight. Known for hits like Coming to America and Beverly Hills Cop, Murphy's not quite as well known as a singer. And yet, back in the 80s, he also released 3 studio albums. While some were funny, like his hit Boogie in Your Butt, which, come on, I mean, it's just the title alone is funny. Others were bona fide radio gold. His song Party All the Time, produced by none other than Rick James, was part of an album of songs, none of which included any comedy. After comedian Richard Pryor told Murphy he couldn't do an album without comedy, the two bet, and Murphy won, reaching number 2 on the Billboard Hot 100 for 3 weeks and being certified as a platinum record holder by the RIAA. So, here's today's question. How much did Richard Pryor bet Eddie Murphy that he couldn't make an album without comedy? I'll be back right after I figure out how to get some comedy into this podcast. Man, wouldn't that turn a good thing great?
That'd be amazing if we could only do that. OG, you are first. Richard Pryor bet Eddie Murphy around comedy. How much did they bet?
Do we have the year in which this bet occurred?
Well, what year did Party All the Time come out? This was a late 80s song. I don't know that I have the exact year, but I remember it was
That's the vibe that I had.
80s.
So this is post Brewster's Millions. So obviously Richard Pryor had a gazillion dollars after inheriting all that money in Brewster's Millions. If you haven't seen the movie, it's great. So he inherited what, 300 million? Wasn't that how much he inherited
in Brewster's Millions?
in Brewster's
as the
Millions,
character in the movie.
Yeah, I was going to say, are you using a movie plot to help your logic?
He didn't get to keep any of that, you don't think?
Has Josh explained the logic on all 7 wins?
Yes.
Does he just go through and just to arrive at the conclusion?
Yes.
We got a lot of airtime to fill, Ruben.
Got it.
Yeah. So he has 300 million, and Eddie Murphy maybe not as rich. I'm going to say that the bet was a paltry $999.
$999. Ruben, how does that sound?
That sounds low. Very low.
So you think they would have bet a lot more
Come
than
at
that?
me, bro.
I don't have logic to defend my answer, though.
If you call what OG just did logic, I think there's a flaw in your...
I don't have flawed logic to arrive where I'm arriving. I'm going to say 20,000.
$20,000. So we got $999 and $20,000. Paula, do you know who Eddie Murphy is?
He's an actor. I do know that. That's probably the only recognizable name in that entire question.
No Richard Pryor.
Not Richard Pryor.
I have no idea who that is.
Okay.
No clue.
Minor league baseball player. Compared to 300 million. Trust me. It's a great movie, Paula. You'd love it.
Let's see. So what logic do I have? Well, 65 million years ago, dinosaurs roamed the earth. Sometime after that, but before today is when this deal took place. I'll be honest, when I heard the question, the first 2 numbers that popped into my head, I figure if it's a bet, it's got to be a round number. Most people bet in round numbers. So the 2 numbers that popped into my head, one was 10,000 and the other was 1,000,000. But if this was like closer to the dinosaurs than it is to today, 1,000,000 was a lot back then. So I'm going to go with 10,000. So I'm just taking the middle of the field goal.
Wait a minute. And Ruben, what was your guess?
I'm at 20.
He's at 20,000.
Next person say under 20 and I'll feel pretty good.
Right. And Paula takes the middle at 10,000.
Why don't I take 10,001? Yeah.
Why?
Because I think that numbers that end in 0 are unlucky.
Okay. Well, there we go.
Yeah.
I got no idea. Our guesses are locked. We're going to see who's our winner in just a moment. Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. Built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you.
This episode is brought to you by Progressive Insurance. Do you ever think about switching insurance companies to see if you could save some cash? Progressive makes it easy. Just drop in some details about yourself and see if you're eligible to save money when you bundle your home and auto policies. The process only takes minutes, and it could mean hundreds more in your pocket. Visit Progressive.com after this episode to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states.
K-pop Demon Hunters, Haja Boys breakfast meal and Huntrix meal have just dropped at McDonald's. They're calling this a battle for the fans. What do you say to that, Rumi?
It's not a battle. So glad the Saja Boys could take breakfast and give our meal the rest of the day.
It is an honor to share.
No, it's our honor.
It is our larger honor.
No, really. Stop. You can really feel the respect in this battle. Pick a meal to pick a side.
Ba-da-ba-ba-ba. At participating McDonald's while supplies last.
OG, you started this off by saying $999. Turns out both Ruben and Paula thought that number was very low. What are you thinking?
I mean, it was a gamble for me, literally, to anchor everybody around something. And I was trying to decide if I wanted to anchor everybody at a low number or the $1 million number or the 500K number. We're going to find out. It's one extreme or the other. I will recognize it's going to be something stupid like they bet $1,
right?
Because you guys have pulled that crap before. Where Doug's like, "How much money did this?" And it's like 74 cents. You know, it's going to be something really dumb like that, or it's going to be like $1 million, and Paula's going to be like, "Son of a biscuit." I knew zeros were unlucky. So many zeros in the answer.
Ruben, you've already seen there's nothing ridiculous at all about this competition. So now that all the bets are in, you've got all the upside, everything above 20,000. What do you think?
Yeah.
You going to win this?
I normally feel like Paula would be stymied in between the two, but she's kind of perfectly in between the two. So I feel like if it was a lower range bet, she's actually got a pretty decent chance, which usually the person in the middle maybe doesn't. But I do think I have a lot of upside here. Anything
you have
high.
it till infinity statistically.
Yeah,
Correct.
if it's $1 million,
Yeah.
you've got it.
Yeah.
The long tail.
I think we all have a decent chance.
Paula, you've been playing this for a long time. You could have pulled a Chelsea Brennan and
I
gone
could have.
19,999.
It was either going to be 20,001 or I was going to pick 10,001.
And so you went 10,001.
Yeah, the two numbers that popped into my head, it was either 10,000 or a million. I just don't think 100,000 is the answer.
Well, your gut can't be wrong 855,000 times in a row, Paula. So let's see. Is OG, Ruben, or Paula bringing home today's winning answer?
Well, hey there, Stackers. I'm Eddie Murphy, fanboy and guy who likes to party all the time, Joe's mom's neighbor, Doug. That's right, it's my old pal Eddie Murphy's birthday today. Man, we got a lot in common. I mean, he's from the mean streets of Brooklyn, and I'm from the middle-class suburbs of Detroit. I mean, that's the same thing, right? He started on Saturday Night Live, and I, of course, got my beginnings on a little podcast called Stacking Benjamins. Parallel lines, I tell you, parallel. Both of us also bet friends that we could make a record out of comedy. All right, well, I lost that bet to OG. Murphy won, although Richard Pryor, the guy who bet Murphy, died before he could pay up. But how much did Murphy bet? Well, this is OG's favorite part of the show. I will tell you that it was $99,001 more than what OG guessed. It was $89,999 more than what Paula guessed, and just $80,000 more than what Jesse/Ruben guessed, because the correct answer is $100,000, making Ruben Jesse our winner.
Ruben brings home the win.
I just like how Paula's like, it can't be 100,000.
I love that I just got finished saying those words. That's kind of perfect.
I feel like I would be remiss to just like, my middle name is Jesse.
Oh.
So this Ruben Jesse thing's been working out.
It really works out.
Yeah.
This is for you, Paula. So close.
Yeah, and Paula thought I was being a little ironic when I said your gut can't be wrong 800,000 times, and I already did.
I said 100,000, but it can't be that.
My gut literally said it just can't be 100,000. Got to be either 10,000 or a million. It just can't be 100.
Oh, well, this is it. Ruben, thanks for bringing home a great birthday gift to both Jesse and to Tess Elizabeth with your wins. That's a nice present for them. All right, let's dive back into our conversation. And I proposed this structure that we maybe start with foundation. So Ruben, we'll start with you as the guy that just won. Cash flow, debt, and emergency fund. Let's just take those areas, right? Kind of your financial position. What's something people learn too late that maybe really needs to be a part of this curriculum to make it really good?
That the traditional way of using a savings account is pretty much irrelevant today.
What do you mean by that?
When I grew up, my parents told me to have a checking account and a savings account. And savings accounts don't earn any yield. And so in reality, what you want is a checking account and either a high yield savings account or a brokerage account where you buy short-term bonds or something. But this idea of a lot of people who went through a personal finance curriculum, maybe in high school, and were told, your emergency fund of $10,000 or $20,000 or $30,000, whatever it is, belongs in your savings account and don't touch it. That's really good for banks and not so great for you.
Paula, what's another area that we need on that curriculum that people either get wrong or learn too late?
I think your behavior matters more than math. I think that's something a lot of people learn too late because it's similar to like food. People will learn what makes sense in theory, but the best nutrition plan in the world is useless if you're not going to follow it. And the same is true with money. And so you might learn what is mathematically sensible, but if you're not going to follow it, then it's useless.
So you're saying like instead of that old 50, 30, 20 rule, which is different parts of your budget, like this kind of tired number, really tracking what you do is what I'm hearing. Tracking what you actually do and learning from it?
It's less about tracking and more about understanding your own psychology. understanding, hey, when I get stressed, that's when all my plans for restaurant spending go out the window. Because if I'm stressed, I'm gonna pop into the restaurant down the street and order a bowl of pasta and a glass of wine or whatever, or a beer. That sort of thing. That's sort of like the observation of your own behavior so that you can find out what your behavioral triggers are, so that you know what are those emotional breakpoints that cause you to steer off of your plan.
And that hits cash flow, could hit debt, could hit emergency fund, could hit all three.
Yeah, exactly. So I think the nutrition analogy or the diet and exercise analogy is, I think, the closest one, because you can design a perfect plan, but when you hit those emotional breakpoints, that's when the whole plan collapses.
OG, cash flow, debt, emergency fund?
I think out of those three, the thing that people figure out too late is that debt is awful in every form and fashion. And there's no such thing as good debt. There's just less crappy debt. And every dollar that you spend paying other people is money that you are not accumulating yourself. Debt
Wait a
sucks.
minute. What about what we said on Wednesday about using other people's money on our April 1st episode?
Yeah. Exclusive of that.
Second go round, let's go to protection. Ruben, I'm going to say protecting your credit score, using insurances, risk management. What do people learn way too late and needs to be a part of the curriculum?
Not my forte. So probably Paula or Josh be better at this. So I'll briefly say, as a planner, I think the one thing that really smart people I meet don't quite get is that life insurance is just for this lower probability event that you actually need it. So you don't want to ever have to use it. Probabilities are that you won't. That's why the business model works for these life insurance companies. So when you buy life insurance, for our firm, we tend to recommend term insurance. You just want to identify what is the gap between what the person who's going to get paid out on me passing needs to sustain my family's lifestyle, if it's your spouse, something like that. What's the amount they need to keep up the lifestyle? It's not worth paying above that. Don't go get a ton of life insurance for no reason. Most people on expectation should not do that. But also identify what that gap is. And that is the amount that you should probably fund for some term life insurance.
I like that in the curriculum, because how many times have we met people in their 20s with no dependents, really nothing to their name, and somebody convinced them to buy $1 million whole life insurance policy as a savings account.
One of the best outcomes of going or not going to college can be just do not end up in college where one of your frat or sorority sisters goes into selling awful life insurance policies when they graduate. That is a great outcome if you can get through college without knowing any of those people, because 23-year-olds without dependents don't need insurance.
Just a general rule too, if you graduate from college and you've got a friend who wants to have a lunchtime meeting and won't tell you what the topic is, that's not gonna go well. Paula, credit scores, insurance, risk management, what do we need to know that we either learned too late or is super important in the curriculum?
I think if you're struggling with debt and you can't pay your bills and all of that, don't worry. The thing to fix is not your credit score. If you're not planning on if you're not planning on moving apartments or taking out any new debt. I meet so many people who are in these very precarious financial situations where they've got credit card debt and they're in a bad spot financially. And I talk to them about, what do you want to fix? And one of the first things they say is, oh, I want to improve my credit score. But why? You're not moving apartments. You're not planning on borrowing any money anytime in the near future. Why do you want to improve your credit score when instead you could focus on doing these other things that would increase the gap between what you're earning and what you're spending? Because that delta is right now way too narrow, and that is the crux of your problems.
But all those funny commercials about credit score, they tell me that's important. That's why I should do it, make it better.
I mean, I'm not saying it's bad to improve your credit score. It's just in the waterfall of the hierarchy, right? The priority list.
Yeah, having it and protecting it is important, but I do feel like it's always people with a lot of debt that are overstimulated in that area.
Yeah.
I think. OG, credit scores, insurance, risk management.
I think the biggest thing on insurance is most people spend way too much time and money insuring low probability events and not enough time and money insuring higher probability events. Ruben talked about life insurance as a 1 in whatever chance of getting hit by a bus when you're 35. but you've got a 1 in 20 chance of being sick or hurt for an extended period of time. And so you look at the life insurance number and you go, well, I can get $1 million life insurance for $50 a month. I'll do that. Instead of saying I need to have $15,000 a month of disability insurance in case I get hit by a car, or in case, I slip off my stairs and I can't work for a while, that's going to cost me $800 a month. That's where the risk is. And you can just look at it from a cost standpoint. It's pretty obvious. The reason that it costs more to have disability insurance than it does to insure your house, even though your house is, $1 million house or something like that, is because the probability, the likelihood of you collecting on it, according to statistics, is way higher than it is than your house burning down. You look at like cars versus houses is another great example. Car insurance probably costs more than your house insurance, unless you live in Texas, and then everything costs too much.
Roughly 300 to 1 risk to 1,200 to 1 risk. Yeah. Chance of something happening to you in your car and something happening to you in your house, something happening to your house.
Or like long-term care insurance as you get older. People go, oh, that's really expensive. Yeah, no kidding.
Guess why?
Guess why? Because it costs a crap load of money to have somebody take care of you 24/7, 365. And statistically, the chance of a couple age 65, 1 out of the 2 people are going to need some assisted care later in life.
This is where that C+ in statistics gets better, because when you start looking at risk management, knowing statistics can save you a ton of money if you couple those just magnitude and probability, those 2 things. Let's go to growing, investing, retirement, and taxes. We spent full episodes on just one of those, Ruben, but tell us what's one thing in those 3 areas that people get too late.
It maybe echoes what Paul said earlier, but I mean, most investors' issue is they just get in their own way. And so what you need is a philosophy around how you want your money to grow through time. So an investment philosophy, you need a design, and you need an implementation plan. If you get those 3 things and you can get out of your own way, to me, that's a foundation to a successful investment journey.
What does philosophy look like when you say that word? Because I think a lot of our stackers don't know what you're talking about.
Yeah, so generally I'd say you need to decide what drives my returns when I'm an investor. So do I think that the market drives returns, so I just want to buy an index fund that maybe looks like the market? Or do I think that a manager should drive my returns and I want to pay someone a relatively higher fee to go pick stocks for me or pick sectors at certain times for me? It's important. You can have a successful investment journey either way. My personal belief is people should probably accept that the market does a pretty good job on its own. So if you can keep your fees pretty low and your taxes pretty low, that's probably the best way to build an investment journey as far as this probability of a successful outcome goes. If you believe in stock picking or something like that, the more you can sort of set it up, be systematic, not change halfway through because you have a disappointing outcome here or there. Markets are very random and noisy over short periods, and it causes us as humans and our behavior and inclinations to sort of hijack our own experience away from ourselves. So whichever route you go, we can all have preferences what we think is better, but whichever route you go, you're always going to be a human. And so that's not a good thing when it comes to investing. And you want to make sure you can design a process where you can get out of your own way.
It was fascinating. Last Wednesday, we interviewed for our normal Wednesday interviews, Claire and Lee, who research what they call stock market maestros. And they dove into how the best of the best stock pickers pick stocks. And what struck me was the fact that there's no gut decisions, to your point. There's no, man, my brother-in-law has this, so it should be in my portfolio. And even people with investments, having that investment policy statement, which no matter what you do is so important. I think the philosophy piece is so huge. Paula, when it comes to investing, retirement, taxes?
To build off of that, I think one thing that people should be aware of are behavioral biases, cognitive biases, things like recency bias or the availability heuristic or loss aversion. People should be aware of these things. They should have names for these things, because once you know that this is just how the human brain is wired, you begin to see those patterns play out in your own thinking. And then you have when you do feel yourself pulled in a certain way, nobody thinks of themselves as panicking. They see a changed set of circumstances and they will rationalize that in light of new information, they're going to change that investor policy statement, right? We saw this happen a lot during the pandemic, where no one said, oh, it's April 2020, I'm panicking. Like, nobody has the thought of, I am panicking at this moment. People will say, oh, X happened, And because X happened, that brings new information to light. And because that new information has come to light, I'm going to do things differently. And that is actually a panic decision, but it is rationalized. And so it's wearing the clothing of reason. And that's why I think it's so important to understand behavioral biases and like cognitive biases, because you can then start to poke holes in that rationalization.
Which is also interesting. These researchers talked about, Paula, having the humility to, instead of defending where you thought you were right, where you were clearly wrong, having the humility to say, no, I'm wrong. And that's how the best investors among us do so well, is through humility, which you would think they'd just be right all the time. They're wrong a lot. They just curb it by making sure they don't compound the error. Investing retirement taxes, OG.
Well, I don't know how I'm going to beat these two guys here because, they have some pretty good stuff. I'm going to say taxes are a year-round event, and most people think about them in February or March, maybe into April, and then go, oh, thank God my taxes are done. And then throw it in the trash and then wait until next February and go, well, it's time to do taxes again. And we know from research that, especially around investing decisions, there's some benefit to paying attention to your taxes. There's some benefits to paying attention to what investments you put in different type of taxable accounts, or depending on the type of account, tax treatment in the account. Ruben was talking about not having a savings account, and instead using bonds or fixed income or something like that has a taxable difference and can be impactful to your long-term wealth. And so sitting down in the summer or in the fall and saying, where are we at? What's going on with my tax situation, and what can I do in these final 4 months to plan for what this liability is going to look like and make any adjustments to assuage those issues. The government sucks at managing money. I don't want to give them anything that they don't absolutely positively need.
I think that's a fantastic place to leave this discussion. Let's talk about what's going on where all of you work. OG, this first fine weekend in April, what do you got going on, man?
Yeah, so it's Easter weekend, after school activity today on Friday, and then my kid's home from college, so I get to hang out with him for a few days before he goes back to school and wraps it up.
Paula, what's going on at the Afford Anything podcast?
On the Afford Anything podcast, we have Jamie Hopkins on the show. He talks about your retirement sketchbook.
This guy?
Yeah, exactly. That guy. He came and joined us up in Westchester County, New York, sat down at the radio station with us. We had a long conversation through lots of different points of and non-obvious elements of retirement planning. So that was what I loved about the conversation. If you think that you have heard, retirement planning 101 or 201, this goes way beyond that. This goes to some sophisticated nuances of retirement planning. So that is Jamie Hopkins on the show.
That is awesome, because you're going to hear him, stackers, on Stacking Benjamins. But if you've ever heard Paula and I do interviews, it's like a great 1-2 punch. We ask completely different questions. And Paula, because we don't plan these in concert, we both were pretty taken by the work that he and his co-author Bonnie did.
Yeah, absolutely love that work. Very impressed.
Really great stuff. That's coming up on the Afford Anything podcast, where finer podcasts are found. Ruben, thanks for hanging out with us, man.
Been great. Thank you.
Well, I'm excited that you made it to the end of the interview, or the end of the hour, because some people, they like
you
take
didn't know
off
this was
halfway.
an interview, did you, Ruben?
He had no idea. So what's coming up on the Fortunes and Frictions blog, or what's coming up in your practice?
Fortunes and Frictions blog, I really write whenever I want. So running the small firm, I'm not as consistent as many other content creators. I just got back from 4 days at Disney with my 3.5-year-old.
You're exhausted.
So I'm on break for like 3 weeks. Yeah. Maybe I'll get a blog out.
But if people want to know more about your firm and what you guys do, how do they get in touch with you?
Yeah, thanks. You can find me on LinkedIn. Again, it's Ruben Miller, and peltomacapital.com if you're interested in sort of getting introduced to our firm. And then the blog, as you said, is fortunesandfrictions.com.
And as OG said earlier, you're a fun guy to follow on LinkedIn. So make sure that you follow Ruben.
Okay, guys.
Yeah, fun and LinkedIn don't go together.
Yeah. If you logged in there every so often, Doug, you'd see. It's a pretty fun follow.
I was going to say, I think there's some people on LinkedIn more and more that I find my happy place more and more on LinkedIn.
He says all the stuff we want to say, but we all have jobs and, responsibilities. And apparently Ruben doesn't. So
Well, that's going to do it for today. Big thanks to everybody who hung out with us for the last hour. If you know somebody that needs to create their own curriculum, this is a great opportunity to share an episode of Stacking Benjamins with them. And I hope that it helps you begin your curriculum for better personal finance habits. Doug, you got it from here, man. What should we have learned on today's show?
Well, Joe, first, take some advice from Reuben Miller. When you're building your own financial curriculum, start with the stuff that matters in your life right now. Then you can worry about learning the stuff you might need in the future. Second, Reuben's like, I said that? Second,
it's like, wait, what?
Second, learn from Paula's sage wisdom. Know thyself. Understand your own emotional triggers and how they impact your spending habits. But the big lesson? Don't bother trying to teach the neighborhood kids why it's important for them to help pay off your mortgage. You need to meet them where they are in their lives. They're just trying to figure out how to save up for a case of Shinerbach. Thanks to Reuben Miller for joining us today. You'll find Reuben's writings at fortunesandfrictions.com, which is a weird coincidence because that's the name of a gentleman's club out by the airport. And also his financial planning work at peltomacapital.com. We'll also include links in our show notes at stackingbenjamins.com. Thanks to Paula Pant for hanging out with us today. You'll find her fabulous podcast, Afford Anything, wherever you listen to the finest podcasts. And finally, thanks to OG for joining us today. Looking for good financial planning help? Head to stackingbenjamins.com/OG for his calendar. This show is the property of SB Podcast, LLC, copyright 2026, and is created by Joe Saul-Sehy. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. And oh yeah, before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamins Show.